According to a recent retirement survey, those who work with advisors have almost double the monthly income over those who don't. Stay tuned for this special episode this morning of Protect Your Assets as we're celebrating one of our fan favorite episodes, our Halloween episodes. Good morning. What a beautiful day. Welcome to Protect Your Assets. I am your host, David Hollander, and it's so great to be with you this morning. For those of you just joining us for the first time, welcome. People around here, they call me the Sandman, and that's because I help you sleep well at night by answering your most troubled tax, legal, or financial questions each week. And that's because I run a tax, financial, and legal firm. We are live this morning right now out of our humble little studio here in downtown Oakland, California, where it is a beautiful, crystal clear autumn morning. If you have a question, maybe something came up, maybe you want to know how to protect your daughter from that deadbeat boyfriend, you can always email me a question. Maybe something comes up during the week. You want to know what the Sandman thinks. Send me an email, questions@pyaradio.com. So next Thursday night, it's Halloween, and I love my treats as much as any person. In fact, I really have a serious sweet tooth for those dark chocolate salted almonds you get at Trader Joe's. But don't tell anybody, all right? In honor of this special night, I started thinking about things that are going on right now that I'm hearing about from mainly you that financial advisors are doing to their customers. And these are great questions because some of them are bad decisions, some are decent decisions. But what are the ones you need to look out for? We're going to talk about that this morning. So if you want to avoid getting tricked into a bad investment, scammed into paying excessive fees, or avoid getting duped by the latest fraudsters we've come across, then this episode should be truly entertaining for you. It's all coming up next, so keep it right here. Now, let's get started. Well, the 6-week streak was interrupted this past week as markets paid attention to higher interest rates. The Dow was off 2.7% for the week, S&P off 1%. NASDAQ had a little bit of sunshine, up 0.2% year-to-date, still up over 23%. MSCI E-Feed Index International off 2%. The 10-year Treasury pretty flat, 4.24%, up slightly as rates were rising a little bit. Oil had a decent week, up 4.3%, closing in over $71 a barrel. And bonds year-to-date still up 2.2%, off for the week about 0.9%, again, because of rates. So even though we had several cross currents this past week, some conflicting information, I think yields right now are rising for the right reasons. Why? Well, because the economy is pretty resilient right now. And since the Fed started cutting, the leadership, when you look at stocks, has been pretty balanced across the board. We're seeing growth. We're seeing cyclical. I mean, it's pretty well spread out throughout equity markets across the entire spectrum. And we still see credit spreads are tightening. So given that we've seen some pretty strong gains this year in the stock market, and there is obviously about a week and a half to go before the election, a further rise in the rates could lead to some more market volatility. This might be a good time to either rebalance or take a look at where you made some money and take advantage of that and lean into whatever you perceive as an opportunity. Or if you're working with an advisor, talk to him or her about that. Anyway, with all that, we're going to talk today about what's going on in terms of different things you need to watch out for in the market, because this is the Halloween show. And so something that we're seeing coming back again, this is nothing new. It's called shell companies. Maybe you've heard about these. These are where the company really doesn't have a real legitimate business operation. They don't really have any cash assets. These can be used for legitimate purposes. However, they can also be used by fraudsters as a vehicle to manipulate stocks. Now, what am I talking about? These are shares of usually traded companies, and these can become targets for those looking to pull off what's known as a pump and dump. You may want to write some of these down and look them up and read about them. Pump and dump scheme in which the fraudster goes out and buys up shares of a forgotten, very low price stock with little to no trading activity. Then they aggressively promote the stock by spreading possibly misleading or outright false information about the company to move the price of that stock up. Once the share price starts to jump up, the fraudster then starts selling those shares off, and the investors that own those shares are technically holding the bag and are losing money as that stock starts to drop. These aren't new, but they recently came back, and we're seeing this when you're talking about AI, artificial intelligence, or again, the crypto markets, hot and cold, but it's been hot for a while. So these are some things to think about. You might want to write these down if you're not really sure about a company that you hear about and you're interested in the area that it's doing. Again, you got to consider the source. So be skeptical of any sort of press release, email that could be called spam that you get, or a text all of a sudden out of nowhere. That's how they're spreading this news now. There might be some promotional materials that you get from an unknown sender. Also, you can research whether the company has been dormant for a while and then brought back to life, sort of like a zombie. You can search the company's name or its trading symbol on the Security Exchange Commission's website. It's called the Edgar database to see when the company last filed their periodic report, if ever. Another resource you could use is the state's office in the state where the company was formed or incorporated. You could look at the charter document filed with that state to provide some detail of the company's history. See if the company recently reinstated business after possibly declaring bankruptcy. How about this? Know where the stock trades. Many pump and dump schemes involve stocks that trade OTC. It's also known as over-the-counter because those have fewer disclosures and other requirements like corporate governance or quality standards than a listed stock. Be wary of frequent changes to a company's name or business focus. Check for very large or frequent reverse stock splits, and know that Q, the letter Q, is for caution. So if you see a stock symbol with a fifth letter Q at the end, that means that the company has filed for bankruptcy. Even without a Q designation, companies that have excessive debt or a history of engaging in convertible debt financing could be risky investments. So these are some of the things you want to watch out for if you're buying or trading stocks right now, particularly if it's something that's hot, if you will. When I come back, are you working with a financial advisor? Well, if so, are they doing everything they can to help you? I'll tell you what to watch out for when we come back. You are listening this morning to the special Halloween episode with me, the Sandman, on Protect Your Assets. We'll be right back. Welcome back. I'm David Hollander, also known as the Sandman, and you are listening to our Halloween episode this morning as we celebrate the holiday that's coming next Thursday. I don't know about you, but I love seeing all those kids of all ages, the 16-year-old who's squeezing into the costume just so they get one more year of free candy, the 3-year-old who's so excited at your door and screaming and yelling and grabbing the candy bars. Trick or treat, love it. So with this theme in mind, I want to help you uncover some of the top tricks fraudsters are using right now to separate you from your money. All right, so first and foremost, we just got a question. This came from Jim in Mountain View. I've been seeing all kinds of ads on TV and on Facebook about REITs, R-E-I-T-S. What are REITs? And second, are they a good investment? Well, thanks, Jim. So REITs stand for Real Estate Investment Trusts. These are fairly complex in that you've got some that are publicly traded, some that are non-publicly traded. That just means liquidity. So make sure you understand that, your ability to get your capital back out of it and how that works. There are ones that focus on particular types of real estate. So you could get one that said just as storage or commercial buildings or apartment buildings or student housing. There's all types. So it's fascinating to look at REITs in terms of an investment as part of your portfolio. Typically, the asset class is sensitive to interest rates. So that's something to be aware of. And they've had a nice little run this year. So, of course, people are talking about them as markets are up. So I just say be careful. And are they a good investment? It really depends on your strategy and what you're trying to do. Sure, real estate could be part of any portfolio. But I would always work with someone who's familiar with that space, who's done it for a while, who has a track record, some history, and could talk to you about how it might fit in your overall portfolio. Those are really important. So great question. Thanks, Jim. Thanks for asking. All right, we're moving on to investments. So if you've wondered about bad investments, maybe excessive fees or what you're paying, or just buying into the latest sort of scheme that's going on, then this show is designed for you. Whether you're already working with a financial advisor or shopping for one, you need to know what to watch out for, and more importantly, what questions should you ask so that you're in the best possible financial position, maximizing your savings. So another trick that we're seeing right now, which is not a treat, is that some advisors use big things that could cost you. Like what? Well, we all know that at some point, like right now, the market is at still pretty good high levels. And at some point we call Humpty Dumpty falls off the wall. We don't know when that's going to be. But when that does happen, and if you're retired or thinking about retiring in the next 6 months, you're going to need monthly income. And so the question that I ask you is, has your advisor developed a specific income plan for you that protects a part of your portfolio from losses if the market were to be down when you needed that income to start turning on? You see, if you're investing in, say, stocks and bonds, ETFs, mutual funds, things like that, you need to check and see how that account did back in 2022. Because if you are able, or you're about to, say, enter into retirement, and let's say we experienced a market like that again, that might create some problems for you. Remember back just a couple of years ago, we saw stocks were off about 20%. A lot of bonds, bond funds were down 15% or more in some cases. Well, the question you should ask right now if you're getting ready for retirement is, if that were to happen again, say in the next 6 months or year, and you're retired drawing income off your portfolio, how would that event, if it was prolonged, how would that affect your monthly income? We did a past show on something called this. You may want to go back and listen to one of the podcasts. It's called Sequence of Return, SOR risk, Sequence of Return risk, to learn more about that. The concept involves you being forced to sell things that you own because the market is down and you need the income to live off of. In that episode, I looked at two different individuals. And they both actually retired at the same time, started with the same amount of money, but purely due to market conditions and market situations, one ran out of money and the other one didn't. So why would you take that risk when it comes to your income in retirement? You probably wouldn't if you knew what I was talking about. So what I would recommend you do is get educated on what we call SOR risk. The next problem I see with advisors is they invest and forget about you. Put another way, has your advisor made trades in your account this year at all? Particularly if they have what's called discretion, where they could trade your account when they trade accounts and you get the confirmations. If they don't have discretion, have they called you lately with any sort of adjustments, given the environment that we've been entering into? In this past year, we've seen some pretty good returns, and rates have still been holding up pretty well. So that has affected bonds as well as something called a fixed indexed annuity. We have been reaching out to our clients and letting them know about these new rates, some of the opportunities that are out there if it's appropriate. Are you dreaming of retirement at some time in the near future? Well, if you are, you should find out if you're ready. I have a complimentary retirement checklist that you can get emailed to you right now. You can go through this at your leisure to see how prepared you really are. Call this number right now and we will send this to you. 866-PROTECT. Again, consider this a treat. This is the big candy bar down the street. 866-PROTECT is my phone number. Call my guys right now. We're sitting here on a Saturday wanting to help you out. Call Phil. He's sitting back there, Dylan. Hey, guys, here's the number, 866-776-8328 to get your complimentary retirement checklist. Coming up next, it's time for our popular They Say segment, where they say you should take your Social Security now before it runs out. What do you think? We'll find out. You certainly don't want to miss this one. You are listening to Protect Your Assets with David Hollander. That's me. We'll be right back. Welcome back. This is Protect Your Assets. I'm David Hollander. People around here call me the Sandman, and that's because this show every week is aimed at giving you some insight and tips on how to keep your hard-earned savings. I know that financial markets, they go up, they go down, and there are always new laws to try and figure out. Let us worry about that for you so you can sleep and relax better at night. Now to continue, Thursday night is Halloween, and I'm so excited to see all the trick-or-treaters in our neighborhood. So this is our Halloween episode. I hope you have liked some of these rejoiners. They're a lot of fun to make, and the crew does such a great job. Now it's time for one of our fan favorite parts of the show. This is our They Say segment, where we debunk common myths, half-truths, and sometimes just bad advice that they say. All right, so here's one they say, and I've heard this. They say that you should take your Social Security now because it's going to run out. Well, should you? You know, it really depends, in my opinion. We use tools to run numbers and look at it from a math perspective, because numbers, after all, usually are pretty close to the truth. So anyway, I just say it depends. And here's why I say that. Typically, you should do your homework. And if you know something about your life expectancy, which could change, obviously, if your health were to change, then that decision could change. But if it's likely you have longevity in your family and there's two of you who are married in good shape, the average numbers now for a couple who's 65, one of you has a very high probability of living into your 90s. So as an advisor working with someone who's thinking about retirement, your advisor should be well-versed in Social Security taxes and trying to develop a plan to avoid this. It's called the Social Security tax torpedo. You may want to write that down. What I mean by this is if you are going to receive any income in retirement, this could be from a pension, it could be rents from a property or multiple properties, in addition to your Social Security. Now, I want you to also add to that something called an RMD. These are required minimum distributions that are going to be necessary from your IRA, 401k. And even this one, even if you have tax-free municipal bonds, the interest that comes off of all this, the payments that come off of all these, you need to plan for the taxes that could be imposed on your Social Security income. Why? Well, because not planning for the Social Security income tax in retirement could very well lead to you paying 40 to 50% taxes. That's right, taxes on your income over the next few years or through your retirement. Because what we do know is that in the next year and a half, when the tax law changes, tax rates are set right now to go up. And so when you start drawing your Social Security income in connection with other sources of income, Social Security income gets taxed as follows. So if you're an individual filer and you have combined income, say between $25,000 and $34,000, you may have to pay income tax on up to 50% of your benefit, Social Security benefit. If you're making, again, single filer, making more than $34,000, that can go up to 85% of your benefit could become taxable. And if you're married filing jointly and your combined income is between $32,000 and $44,000, then you have to pay up to 50% of tax on that benefit. And more than $44,000, you're looking at 85% of your benefit may be taxable. So what that means is if your combined Social Security income, say, is $80,000 and you have other income, at least $68,000 or 85% of that $80,000 income is going to hit your tax return as ordinary income. And then you got to add to that any other sources we were just talking about, like your RMD, your pension, any sort of rents you're collecting. And so that Social Security income of $68,000 is going to get taxed again. I know you're shaking your head right now, right? You're saying, what do you mean taxed again? I just paid taxes on it when I earned it. Remember on your paycheck at SSDI? That's Social Security tax. That's right. And then they're going to tax you again. So you're losing more. It's hard to get it back, right? So if you're an advisor, you're not digging into your tax return and helping you build income in advance that at least looks at these things, the penalties that could be involved, well, they should hopefully be doing everything they can to help you protect and have more money in retirement. I've also heard clients say recently that their advisor had special proprietary funds that were only available with this particular firm. Do you think these advisors are only showing you those funds because maybe they get paid more? Many proprietary funds have something called internal expenses, which pay not only your advisor, but also the fund manager and the firm fees. Depending on how you are invested, your management fee, in addition to the internal expenses I just mentioned, might create high, maybe even excessive fees, which reduce your overall growth in your portfolio. So I encourage you to dig into these a little bit, ask for the disclosures, and find out what the fees are. And if they're additional, meaning that they're more than what's customary, is it worth it? Is the total return worth working with that particular advisor who uses these types of funds? Or are there alternatives which might be less expensive, but still give you what you need? And by being more cost efficient over time, potentially provide a better rate of return. Okay, I know what you're saying right now. How do I really know what I'm paying or what my plan is costing me right now? You may think it doesn't cost you anything. I hear that a lot. Well, I don't ever see a fee, so it's free. Nothing is free, right? If you want to find out what it is, then we have a special X-ray tool. I call this the portfolio MRI, where we can show you in a report what your funds are invested in, what they're costing you, and also what the performance over time, again, what it's looked like. We can produce these for you. If you'd like to see what I'm talking about, then just pick up the phone right now and find out. Call this number, 866-PROTECT. The number this morning, it's 866-PROTECT, to find out if you are paying more than you should be right now on the things that you're involved in. It's really easy. We'll do the heavy lifting for you and then get you this report. Call this number, 866-776-8328. Now, coming up next on our special Halloween edition, find out how one of a very well-known firm said you could take out 7% of your portfolio and not run into any problems. Find out how one family almost lost everything following that advice. Keep it right here. We'll be right back. Welcome back. I'm David Hollander, also known as the Sandman, and you are listening to Protect Your Assets this morning. This is our Halloween-themed episode, as we're helping you protect yourself from some truly ghastly financial advice. If you want to avoid getting tricked into bad investments, scammed into paying excessive fees, and avoid getting duped by fraudsters, then this episode today is designed just for you. So today we've uncovered some pretty horrifying sales practices of financial advisors, including being taxed way more than you should, just focusing on returns and paying much higher fees through proprietary funds, or advisors are sometimes incentivized to peddle specific investments that pay them and their companies more fees. We've discussed how important it is to work with a wealth advisor who coordinates your plan with taxes. And hopefully they're taking a look at your taxes each year and trying to help you plan accordingly. All right, so I've got one last example. You've probably seen maybe the commercial, regular looking guy or gal on the screen, nice office. They're on your side. Yep. They have really great marketing. I'll give them that. They say they're all about lower fees and they only do well if you do and all this other stuff. Anyway, there's a situation where they told someone they could take out 7% a year of the portfolio and the performance would do all the rest. And I'm just saying, watch out, because sure, the market's been pretty good these last couple years. But my question is, what happens when? I had come across a family who had retired, sold their business, and put everything with this group. And they were told that they should take out 7% of the portfolio each and every year to live off of it, and the market would just take care of the rest. Well, a longer bear market came along, and as they continued to take out that 7%, and the portfolio went down over 50%, the withdrawals started to become a real problem for them. You see, as the portfolio goes down, it takes some serious returns to get it all back, especially when you're living off of it. So right now, it's been pretty good for a while. As I was talking about at the top of the show, if you missed our market segment, you can go back and listen to the podcast that will be put out there next Tuesday. You can listen to the market segment. But there are some people right now who are worried about the future, worried about the markets, worried about when that drop will happen. So is it just around the corner? We don't really know. No one ever really knows, but it's possible. So I would just encourage you to think about, if you're at or near retirement or in retirement, be careful about how you're going to be taking money out, or how you're taking money out of any particular investment. And think about having different pockets of things that produce income in bad times. And hopefully those have been tested. And if they haven't, well, talk to an advisor who's been through that. Maybe has some experience and can show you how to build something that still produces that income when things are tough. You don't want to be retired thinking everything is fine, and then all of a sudden you get a phone call that changes your life dramatically, right? Because you can't go back to work. You don't want to outlive your money, do you? Of course not. So think about what we're talking about this morning. And the following, remember I was talking about this before, the 2018 tax rate. Remember that change? Well, that is going to phase out in just about a little over a year from now. It's going to be gone. It's going to go back to what it used to be. This is now the rules. You can read these and see them. And so if total return is important to you, you have to be looking at taxes, because if you're living in California, you're paying federal and state tax on your income. It's a big number. And right now is the time to look at that and pay attention to it and try and keep more of what is yours. Because before it's too late, you can get answers that maybe you didn't know were out there. You know, it's kind of sitting like with your tax person. Hopefully when you're doing your tax return, they sit there with you right before and they say, hey, you could do this or you could do that, or you should do this, maybe do that, and you do that. And it works out, right? When you file your return, you save some money. Well, this analysis is suited for those who are recently retired, or maybe you're thinking about retiring in the next 5 years and you're looking at total earned income when you add everything up of $250,000 or more of income. That's possible, particularly when you have your RMDs kicking in and your Social Security. This really means a lot to you. So if you're in that situation or that's getting close or you're thinking about it, then consider this. I'm the house with the big candy bar today. And if you'd like to get yours right now, call this number, 866-PROTECT. You got Dylan, you got Adrian back there, ready to talk to you. It's a Saturday. Give them a call. Find out how to pay less. 866-776-8328. Call us, 866-PROTECT, because we're here to help you protect your assets. I'd like to give a big thanks to the Protect Your Assets team for this great Halloween show today. Hope you had fun. My executive producer, network manager, Kevin Renfer, and of course, all my fabulous producers back there answering the phone and doing all the work. You've got Adrian, you've got Dylan, you got Phil. They're all back there ready to talk to you. 866-PROTECT. Without my team, I'm just another pretty voice on the radio. You've been listening to the Protect Your Assets show. I'm David Hollander, the Sandman. Go out and make the rest of your life the best of your life.